You'd think I'd have that figured out. Good afternoon, everyone. Thanks for joining us today. I'm Jonathan Sanford. I'm Executive Vice President here at the Global Business Alliance. I was on mute there at the top, but great to see you. Appreciate you joining us today. Very excited about today's program. For those of you who may not be aware, GBA is the premier advocacy resource for international companies who operate here in the United States. These are companies that have succeeded in home markets around the world and have made a decision to invest and create jobs here in the United States. We represent some 200 companies, some of the most well-known brands in the world. And our mission is to promote and defend an open economy that welcomes international companies to invest and create jobs here. While the lion's share of international investment goes into the manufacturing sector, international companies actually operate across every facet of the U.S. economy. And cumulatively, GBA members have operations in every congressional district across the country. So for those who are tuning in from Capitol Hill, I encourage you to check out and learn more about what our companies are doing in your state. You can find a lot of that information on our website, which is globalbusiness.org. Once again, welcome to the fifth installment of our Economic Advisory Council. This is a collaboration that I'm very excited that we have in partnership with the Institute for International Bankers. What I love about this series is that we're able to bring you some of the most interesting and timely news available from top economists in the country. This is direct information straight from them. And so you're getting an unvarnished perspective on the U.S. economy in real time. So with that, let me turn it over to my good friend Bridget, who's the CEO of IIB. But before I relinquish the floor, I just want to mention that this is our last time to get to collaborate with Bridget. Many of you may know she's announced her retirement in the new year. And so I just want to say it's been a delight to work with you, Bridget, over the last few years. Wish you all the best in your retirement, and want to just say you've been a delight to work with and a really great representative of an important economic engine for our country.
Jonathan, thank you so much. The pleasure has been mine. This has been a great collaboration, and we're really excited. I'm very excited to be able to welcome everyone to the latest installment of the IIB and Global Business Alliance's Economic Advisory Council series. And as they say at my gym class, last one, best one. So we're going to close out 2022 strong, and I know there's going to be a lot of great content in 2023, and I'm sure you're all looking forward to that. So just a quick word about the IIB, Institute of International Bankers. We represent the U.S. operations of nearly 80, not quite 800, internationally headquartered banks of various sizes, portfolios, geographic reach, and clientele, all of which are contributing significantly to the U.S. national economy, but also state and local economies. You know, IIB members, you might not see the bank names on street corners, but I can assure you that the presence of the foreign banking community in the United States is being felt across the country through project finance, through corporate and commercial lending, and through our capital markets operations. Today, we have the pleasure of hearing from Carl Riccadonna, Chief U.S. Economist at BNP Paribas, who's going to share his outlook for the economy heading into 2023. Carl's going to share with us his thoughts on the actions the Fed is taking to fight inflation and their impact on the U.S. economy as well. I know that's a very hot topic, especially given this week's FOMC meeting. Prior to joining BNP Paribas, Carl was at Bloomberg, where he was chief U.S. economist and head economics research for the Americas, and later chief industry economist for Bloomberg Intelligence. Previously, Carl spent 13 years at Deutsche Bank, where he ultimately assumed the role of senior U.S. economist. He has contributed to numerous research publications, maintains a frequent and visible presence through speaking roles at industry events, and regularly appears on broadcast media. And earlier we were talking about, he's also got a strong Twitter presence. So you have lots of ability to hear, even after today, hear from him and his outlook. And another great thing about these events is, well, Carl is here in the US, we, Global Business Alliance and the IIB, have the advantage of having members that have a global outlook as well. And that's what we think makes this particularly valuable. I want to strongly encourage everyone to take advantage of the opportunity to have an expert here with us today by asking questions using the Q&A function in the platform. We've reserved some time at the end after Carl's remarks to take those questions, so please send them our way throughout. Carl, thank you so much for joining us today as part of our Economic Advisory Council. We're really thrilled to have you, and we look forward to learning from you. So the floor is yours.
Okay, thank you so much for that very kind introduction, Bridget, and congratulations on your pending retirement in the new year. Hello from New York. It's beautiful day, clear skies, but there's some troubling clouds on the economic horizon. And so I do have some slides to kind of supplement the discussion today. So if we want to pull up the first slide here, and we'll fast forward onto the next page where we have a lot of numbers. So they're there for your benefit if you really want to get into the weeds, but don't focus too much on the table of forecasts here. But in very broad brushstrokes, I'd like to kind of lay out what we see for the 23 outlook. I guess maybe better than what we see in the slide here, we'll jump ahead to the first graph on page 3. And we can kind of see where we've been and where we're going. And that's the essence of what you saw on the previous table. This is economic activity. This is gross domestic product. We can see the dramatic swoon in 2020 as the COVID crisis got underway. It was the deepest downturn the U.S. economy had seen going back to the Great Depression. We had a massive dislocation in the labor market. So this was an enormous disruption to economic activity. We also saw both the Fed and the federal government swooping in with dramatic stimulus packages. There were trillions of dollars spent in terms of tax relief and rebate checks and aid to companies and whatnot. And in addition to that, the Fed moving into kind of what I'll say is unforeseen territory, uncharted territory in terms of cutting interest rates to zero, but doing a whole lot more than that with the massive expansion of the Fed balance sheet. And while it's easy to say, well, we got the dosage of the medicine a little bit off, given the inflation problem that has developed, and we'll talk more about that in a little bit, we can see that deep dive in the economy that happened really in a 2-month period, right? So this was breathtakingly fast and eye-wateringly deep in terms of the downturn. It did quickly reverse. And we can see that maybe we overdid it in terms of the medicine applied to the economy or the steroids applied to the economy. Because as we look at 2021 in the chart, you can see a dramatic surge in GDP as well. So it was kind of a slingshot effect there. And we rebounded to a growth rate of about 13% in year-on-year terms. That's a growth rate the U.S. economy had not seen since 1950, around the mobilization ahead of the Korean War. So this is a very unusual economic recent history for the U.S. economy. But we hit 13% growth and we started to slow. Part of this was the normalization. The economy had reopened and then started to stabilize. A big part of this was the fading effect of fiscal stimulus. Those rebate checks got spent, especially by lower income households, and so naturally things started to cool down. And also the Fed started to step on the brake pedal, or at the very least remove their foot from the gas pedal. And so we've been in an environment of moderation. We were at 13% growth in the middle of last year. We were about 6% by the end of last year. By the middle of this year, we were closer to 2% growth. And by my forecast, which you saw on the prior slide, we're heading very, very close to zero by the end of this year. This is relevant to the broader macroeconomic landscape because we shouldn't think of the economy as being all that different from a jumbo jet, right? It can slow down from various speeds, but at a certain point, if it slows down too much, it becomes vulnerable to disruption or shocks or destabilizing factors. And that's exactly where the economy is headed at the moment. So we can see the dotted line in this chart is our expectation for economic growth over the next year. And we're heading very close to economic contraction in 2023. We would put the risk of recession at about 65%. And you can see that dotted line dipping below zero next year. So this does mean we have a recession built in. But we have to be careful as we say recession because there's a tendency to be conditioned by recent experiences. And when we looked at the last couple of recessions, they were exceptionally severe downturns. We had the COVID crisis, obviously a terrible downturn. We also had the recession before that, the 07 to 09 recession, was the global financial crisis and the bursting of the housing bubble here in the U.S. So those were unique recessions. And the type of recession we're looking for is more like a run-of-the-mill recession. I think if we had to draw a parallel, I think that the parallel is more like what we saw in the 1990-91 period. That was around the first Gulf War. We had high oil prices. The economy contracted by about 1.5 percentage points, moderate back up in the unemployment rate. That's the kind of environment we're looking for in the year ahead. So it is not a good one by any means. But we shouldn't think crisis. We should think moderate contraction in the economy, a peak to trough decline of about 1%. We see the unemployment rate, which is currently 3.7%, heading up towards 6%. So it will feel like a recession, but it won't feel like an economic crisis. If we jump ahead to the next slide, then we can see what the Fed has been doing in the background here. And what I've done is it looks what I call this a spaghetti chart. Because it's a big pile of lines. But what I've done here is shown various tightening cycles from the Federal Reserve. And we can see that the green line on the left-hand side, that's the current tightening cycle. So the Fed has tightened interest rates by nearly 4%. At the December meeting, we expect another 50 basis points or half percentage point of rate tightening. And so we can see relative to what the Fed usually does, they are acting very swiftly and very aggressively. And we should also say that in addition to the interest rate tightening, there's this thing called quantitative tightening, which you've probably heard of, which is the Fed shrinking its balance sheet. And that would actually make that green line even a little taller than what we show in the chart here. So the Fed is acting very aggressively. Earlier this year, it seemed possible that maybe the Fed could pull off a soft landing for the economy where they could slow things down enough to start to cool the inflation pressures down without necessarily pushing us into recession. But it looks like that ship has sailed. The labor market remains exceptionally tight. As I mentioned, 3.7% unemployment. The pace of hiring is stronger, too good to be true, stronger than what the Fed would like to be seeing for an economy that's normalizing. And so this is telling the Fed there's more work to be done. And by the Fed having to push rates to a higher level, then this makes recession kind of a fait accompli. As I mentioned, we would say about 65% chance of recession in the new year. And what I haven't talked about yet, but we'll get into greater detail in just a bit, is the inflation landscape. And the inflation numbers, we've had one consumer price index or CPI report that looks favorable. But that is just one report among many, many, many bad ones over the course of the last year and a half. And so we can't get too excited. Don't pop the champagne corks just yet. Those champagne corks are about 8% more expensive than they were a year ago. And we've got a long road ahead on the inflation front. And we'll talk about some of those dynamics a little bit later on as well. But given the residual momentum in the labor market, and the high and sticky inflation pressures, the soft landing way out of this It looks like the window has maybe not closed entirely, but it has closed considerably. And so it looks like the Fed will have to push us into that kind of modest recession I described to accomplish their objectives. And the Fed's objective is maximum employment in an environment of price stability, which to Fed policymakers means a return to 2% inflation. If we jump ahead to the next slide, keeping in mind that steep trajectory we saw of Fed tightening, this has led to a tightening of financial conditions. And that's what I show in this chart is just, I take that GDP chart that we were looking at, and I overlay the blue line in this chart, which is a financial conditions index. I take the Bloomberg Financial Conditions Index in this case. It's a very straightforward index, easy to understand, publicly available. And we can see a decent correlation with GDP, but we can also see how sharply financial conditions have tightened, right? So if you can kind of choose your own adventure here, and if you want to know where GDP is heading, or if you want to have a sense if that dotted line, which is my team's GDP forecast, looks correct, well, we can see a good correlation here. We see financial conditions have tightened appreciably. They've eased a little bit since the November Fed meeting and the latest CPI report, which looked favorable, but not by any means to an extent that would say, okay, soft landing is coming back on into the picture here. It is still very much consistent with recession for the economy. Financial, and we can see this in a lot of ways. Financial conditions aren't just the stock market or the shape of the yield curve or whatnot. It's reflecting more broadly how interest rates and Fed policy is impacting the macroeconomy. We can see this in a lot of different ways. So one way we see this tightening of financial conditions is in the residential real estate sector. We can see that the volume of home sales down very sharply. Home prices are still in positive territory, but the trend is not friendly. It's starting to slow appreciably as well. It was about 13% year on year. Now it's closer to 10% year on year. It's been decelerating over the last couple of months. That's kind of the earliest point in the economy where you start to see interest rate policy starting to bite into economic activity. So you watch housing as the canary in the coal mine. We see very much that Fed tightening is, in fact, taking hold. But we're starting to see it in some other sectors of the economy as well, including the labor market, including some other interest-sensitive spending categories, not necessarily cars, because automobile sales, there's been so much pent-up demand due to the microchip shortage that's proving to be more resilient, but ultimately it will take a toll there. We see it in business spending on capital projects and big infrastructure types of projects and whatnot. So the Fed tightening, it's been very aggressive, but it's also happened over a very short period of time. So there's still a lot of tightening in the pipeline that hasn't been fully realized in the economy. And so the Fed is aware of this. Traditionally, the lag from Fed tightening is about a year to a year and a half. And so they know that a lot of the actions they've taken this year have not been realized in the economic data. And therefore, there's a risk that they overdo it. And this is why Jerome Powell, in his speech yesterday at the Brookings Institute, was talking about a risk management approach where they know that the pig is in the python. They can see the tightening coming down the pipeline, so to speak. And so they're ready to downshift, not cut, downshift. So tighten at a slower pace relative to what they were doing previously, and kind of find a parking spot for interest rates. And in our view, that's going to be in the range of 5 to 5.25%. So we're at 4% now. Look for another 50 basis points in December, 50 basis points at the next meeting, which happens to be in February, and then maybe another 25 at the March FOMC meeting. That gets us to 5.25. That is definitely restrictive territory. So the Fed is not merely taking their foot off of the accelerator. They are pretty firmly pushing onto the brake pedal at this point. And we can see that in the financial conditions chart. What will this do to the economy? Well, we see it happening in the housing sector already. We've seen a pretty impressive appreciation of the dollar. So a stronger dollar then puts a clamp on the export sector because that U.S. exports then are more expensive in overseas markets. So we already see that happening. We have kind of a tidal wave of cheap imports coming into the country as a strong dollar makes imports cheaper. And so that also is putting a pressure on domestic manufacturers. And we saw that in the latest data point. The manufacturing ISM was out at just 10 o'clock this morning. We see that the factory sector is sliding into contraction. We had a labor report earlier this week that showed factory employment starting to roll over as well. We'll look for confirmation in the official statistics, which are out at 8:30 tomorrow morning in the monthly jobs report. But it is spreading from housing to the factory sector and starting to take greater hold in the economy. So we do see what the Fed is doing is working. And to put that in a little bit more granular detail, on the next slide, I just show what this GDP slowdown that I've been talking about, or the broader economic slowdown, will do to the labor market. And here we show kind of a broad history from 1960 up to the pre-pandemic period of how economic activity and job gains or hiring are correlated, right? It makes sense intuitively that they should be related, but let's test it, right? Let's see if it actually works. And when we put those dots on a chart, or the data points on a chart, we can see a pretty useful relationship. Maybe not linear, it's more of a curved line, but we can see a relationship. And so here's the choose your own adventure chart. Take your, whatever you think GDP is going to be next year. So I said it's about zero. So you can find zero on the x-axis. Go up to your line and see what that implies for non-farm payrolls. And by this relationship, this tells you that we're heading towards job losses relatively soon. Maybe not tomorrow morning in the November jobs report. I think we still have a few more months of decent job gains, but we can see that the clock is ticking, and if the economy is really heading to zero, then we know we're heading towards job losses. And if you say, well, I'm too conservative, maybe we only get 1%. Well, go up to your chart and you can see 1% GDP growth would basically be a hiring stall next year. So you can kind of synthesize that from what we see in this relationship. And the other side of the coin, I talked about the Fed's dual mandate. One side is maximum employment, which we will be backing away from next year if we're talking about a contraction in the economy. But the other side of it is inflation. And so if we jump ahead to slide number 7, we can see what this similar relationship would look like if instead of comparing two non-farm payrolls or employment, instead we look at core inflation in the economy. It's a little bit of a wider dispersion among the dots, and I look over a more recent time period, but we can still fit a line here. And so this should give us some confidence that with the economy slowing down as much as I've highlighted, not only in terms of what we've realized from 13% down to a little bit less than 2%, but also as we head from 2 towards 0, this should give you confidence that what the Fed is doing is ultimately going to put a major dent in the inflation data. And that was such a critical issue in the midterm elections that we just got through recently. It's very much on voters' minds. It's on the minds of the Fed, on the minds of politicians, of course. And we can see also if we're heading towards 0 in terms of GDP growth, then we should be looking for considerable improvement on the inflation front as well. And we've seen some of that, but we're still very much at the tip of the iceberg. Jumping ahead to the next slide, I'll move a little faster over the next couple of slides just so we can have some time for an audience Q&A, because I think that's maybe the most important or interesting part of the discussion. But what we can see here is a couple different measures of the labor market. Maybe you're saying, well, it seems like we're seeing some strong jobs numbers. I don't know if I believe what he's saying about this labor market slowdown. And so what I've done here is the dotted line is the latest data. Then I've taken a 12-month moving average, a 6-month moving average, a 3-month moving average, and we can see all of those lines are really negative sloping, which tells us that there is a very real slowdown happening in the labor market at the moment. And so it doesn't feel too bad just yet because we're printing 200,000 plus on non-farm payrolls. That's enough to keep the unemployment rate at a very low level. But if this trend continues, if we start to get below 100,000 jobs per month, that was a number Jerome Powell highlighted yesterday at Brookings, then we start to see a real deterioration in labor conditions, and we start to see that unemployment rate start to move higher. And there's a lot of questions in the marketplace. Will this Fed have the resolve to keep their foot on the brake pedal once we start to see more recessionary economic conditions coming about in terms of rising unemployment, falling industrial production, consumer spending pullback, defaults on mortgages and whatnot. We'll get to that a little bit later in the discussion. But the next slide I want to highlight is kind of looking, again, this is a view from 50,000 feet. Here I've taken GDP growth and employment, two of the themes we've been talking about, and just show where they are relative to that dotted line. And that dotted line is kind of an eyeballed best fit with where we stood in the pre-pandemic period. So kind of Q4 of 2019 and Q1 of 2020. So we can see the peak there. We see the sharp decline in lockstep for both economic activity, GDP, and non-farm payrolls. They both declined by a very similar amount, right? They pick the bottom at the same point, but the recovery looks very different. And in the recovery, we can see that the economy bounced back a lot faster than the labor market. Part of this was, people's resistance to return due to COVID risks or whatnot. Parents being stuck home because schools were, virtual at the time. For a whole host of factors, there were lots of retirements, not just Bridget, but lots of other retirements during the pandemic. So if we look at workers in the 55 plus age demographic, there was a big increase in retirements and drop in labor force participation, and so there was a big divergence between the two. Well, if we step back again, the view from 50,000 feet, and think about this, a big gain in terms of economic output with only a very modest recovery in the labor market means productivity or output per worker hour must have exploded in a good way. And in fact, it was running about 4 times as high as it did during the previous economic cycle. Right, so we had massive productivity gains. That helps to support businesses' bottom lines and profit trends and whatnot. But we know productivity is a mean reverting series. So on slide 10, I show the productivity trend. Right, so if we kind of take the two lines from the prior chart and combine them, that gives us productivity, output per worker hour. And then I have a fitted trend line here. We see that surge in productivity in the early stages of the post-pandemic recovery. And then now we see productivity rolling over again. It hasn't fully gone back to trend, but it is definitely rolling over. And what this tells us is this, as productivity kind of comes back to earth, then this relationship between economic activity and labor conditions, which had kind of diverged wildly early this year. Remember, we had negative GDP growth in the first 2 quarters of this year, and we still had about 3 million jobs created over that same time period. So some people looking at the GDP numbers were saying we're in recession, and people looking at the jobs numbers were saying we're in a very strong rebound in the economy, right? So it's 2 very divergent viewpoints. Now, as productivity rebounds, suddenly the honeymoon is over, and it's back to reality where hiring statistics reflect underlying economic conditions, and we see underlying economic conditions, heading towards zero or even contraction. So that tells us that the labor market is indeed due for a pretty significant downturn. Now, there's lots of economic data out there. A lot of the data gets revised after the effect, and so sometimes you can take emerging economic trends with a little bit of skepticism because revisions could change the story pretty dramatically. And we see that all the time as macroeconomists. But one data series that comes from down in Washington, D.C., that's pretty reliable is the tabulation of everyone listening to this webinar, including myself, the portion of your paycheck that is withheld every pay period. We call them tax withholding receipts. It's reported by the U.S. Treasury 1 day later, so it's very timely data series. It is economy-wide, right? There's no issue of like phantom reporting or whatnot. No one pays their taxes on income that hasn't been realized, right? So the withholding portion of your paycheck, we tabulate that to a macroeconomic level. We can track that trend. And when we look at that trend, it was growing at about 13 to 15% at mid-year in year-on-year terms. It has now fallen to about minus 2%. So if tax collections are actually shrinking, that tells us that yes, the labor market absolutely is slowing, and we're going to start to see some weaker payroll numbers and a higher unemployment rate in the months ahead. So very much consistent with the recession call. In the interest of time, I'm going to move a little bit quickly over the next few inflation slides. But on slide number 11, I just show a whole slew of measures of inflation, whether it's producer prices, consumer prices, inflation expectations, and I show the green bar is the peak value we've seen in the post-pandemic era, and the black bars or notches are basically the most recent readings. And we can see that there is still a very persistent inflation problem out there, but it is starting to come down from the peaks. Moving ahead to the next slide, we break down what's driving inflation. This comes from the San Francisco Federal Reserve. The red component is supply chain issues like microchips and disruptions to the oil sector and port backlogs and whatnot. In the blue section is what's driven by demand or excess demand, like rebate checks giving households a sense of a financial windfall, and they run out and spend lots of money, or excess savings that were accumulated during the pandemic, and people are tired of sitting in their basements watching TV and are running out to buy airline tickets or other things. And so, what we can see here is that as the supply chain issues get resolved, and if we make it past the rail strike, that's a big factor as well. But the backlog at the ports has largely been wound down. There's still some issues with microchips, but that backlog's being worked through. So we see a lot of supply chain healing. And so the question is, well, how much does that fix the inflation problem? Well, the way to think about this, look to the right-hand side of the chart. Look how much of that latest line is basically red. And I would say eyeballing it, it's about 40%. That tells you just the supply chain healing that is already well underway. Look at container shipping costs, trucking costs, rail freight shipping costs. All of these things are good barometers. We can solve 40% of the inflation problem, maybe 50%, because the green is kind of the ambiguous category. So we can fix half of the inflation problem just through supply chain healing. That's the easy, low-hanging fruit. That gets you from 8% inflation down to 4% inflation. That's a big improvement, right? And that's the easy stuff to achieve. We kind of get there by about middle of next year. Cutting it in half again from 4 to 2, that's the difficult task. That's the sticky inflation that is caused by wage pressures, tight labor markets, shortage of workers, all of bargaining, a sense from workers of increased bargaining power, all of those factors. And that is much more difficult to eradicate. It's rent pressures. It's a cost of right behind me a Broadway ticket or a dry cleaner or any type of service cost, healthcare costs, etc. That tends to be tied to the labor market, and you typically don't get relief on that front until the labor market starts to loosen. And we probably need to move to 4.5, or maybe even 5% unemployment before we start to see the relief on that side. So it'll be easy to get the low-hanging fruit, but then getting the rest of the way back to 2% will be quite difficult. On slide 13, I just kind of break that inflation data down a little bit more between what's happening on the goods side and the service side. I direct your attention to the right-hand slide there where we show goods prices in blue and services in green. And so we can see, most of this improvement on inflation is the supply chain kind of goods story. In terms of wage inflation, if we jump ahead to slide 15, I'm trying to be cognizant of time here, so we have ample time for Q&A. This is kind of a measure of wage price dynamics in the economy. This is something the Fed is watching very carefully. They're very concerned about a potential wage price spiral where you have workers earning more wages and then consumer prices go up. How workers realize that prices are rising and they demand higher wages, and you end up in a vicious feedback cycle. And what we can see at the moment is that wage pressures are at high levels. They're undesirably high. for kind of inflation stability in the economy, but they're not spiraling out of control. So we're not in a wage price spiral, but this is definitely something to keep a watchful eye on. I'm going to just jump ahead a few slides here to slide 18. A few more key points I want to make on the presentation. And so here I show inflation expectations, right? Because I hear from so many people I speak to, oh my gosh, we've gone back to the Jimmy Carter era. It's a stagflationary 1970s wage price spirals, which we already talked about, and it's kind of the disco era all over again. In fact, it's not that. So inflation may be back to levels that prevailed when bell bottoms were in style, but it's a very different backdrop. The inflation problem that ultimately was solved by Paul Volcker in the early 1980s and some of the policies of the Reagan administration were really 15 years in the making. They started with Lyndon Johnson's Great Society in the mid-1960s, built up through the 1970s through two oil crises, and it was a very long-term problem that developed. The problem that Jay Powell is confronting at the Federal Reserve was more like 15 months in the making, right? So it is probably a much easier resolution of this problem. And a key reason for that is we haven't, the public's perception of inflation hasn't become destabilized the way it was in the early 1980s. And so here I show both CPI, but also inflation expectations, both year ahead and over the longer run, a 5 to 10 year horizon. In the 1970s, it had really become disanchored or destabilized among American households. In the current environment, we've seen some erosion, but not nearly the erosion that we saw in the latter part of the 1970s. So it really is not a fair thing to say it's the 1970s all over again. If we jump ahead to slide 20, I just want to make a point for anyone who runs a small business or a big business like the $20 trillion U.S. economy. This is just a very fundamental way to think about what the Fed's doing. If you have doubts, okay, this Riccadonna guy is talking a good game, but is the Fed really getting ahead of the problem? And so whether you're a small mom and pop flower shop on the corner or you're the $20 trillion U.S. economy, the cost of financing your business absolutely matters. And it's the cost of that financing that business relative to the growth rate of your business, right? In this case, it's GDP versus, pick an interest rate. Here I use the Fed funds rate or the overnight lending rate. And what I've done here is I've circled the periods where the Fed has pushed interest rates above the growth of the economy. And every time the Fed does that, the economy heads into a recession. I should add the gray shaded bars you see in this chart are recessionary periods. So there were times when the Fed intentionally did it, like the early 1980s under Paul Volcker when he was breaking the back of inflation. And there were times where the Fed kind of unintentionally did it as they were trying to slow the economy, over-tightened, and caused a recession. So sometimes they do it on purpose, sometimes it's not necessarily on purpose. But when the Fed pushes interest rates above the growth rate of the economy, things slow down. And it's easy to think about if you're a small business and your business is growing 5% and your cost of financing is 2%, you're going to continue to invest to grow your business. When the bank calls back and says, so you know what, the next loan we give you is at 6% and your business is growing at 5%, you're probably going to say no thank you, right? Same thing applies to the macroeconomy. And we can see that the dotted lines are, again, the forecast from my team of both GDP growth and the Fed funds rate and how the Fed is basically inducing recession in 2023. We'll fast forward. My final point will just be to talk about how this plays into the 2024 elections. Knowing my audience, I thought that would be an interesting way to conclude and move on to the Q&A. But just one final point I'd like to make here as we talk about this Fed-induced recession that we see coming in 2023, because kind of if we can connect the dots of what we've discussed to this point in the conversation, inflation is improving, growth is falling apart, but it's going to be hard work to get inflation back down to 2%, right? this means that as we go into recession next year, the Fed is not going to be able to take the usual role of white knight, riding to the rescue, cutting interest rates forcefully and aggressively and quickly to re-stimulate the economy. Because of this persistent inflation problem, it's going to take a little bit longer. And so the Fed is going to have to sit on its hands and let the economy kind of stew in its own juices, so to speak, while the recession wrings the inflationary pressures out of the economy. So just the final point I want to make then on slide 22, if we can bring the slide back up, what does all of this mean for the 2024 presidential election? And there's something that Arthur Oken actually developed in the Lyndon Johnson administration. He was an economist, and he called it the misery index, and it's basically the consumer price index added to the unemployment rate. So this is very unsophisticated economics, but we'll call it kitchen table economics. If either the cost of living, inflation, or unemployment is rising, households are becoming more miserable. If both are rising, then they're definitely becoming more miserable, right? And economics, right? The unofficial motto of the Clinton campaign in '92 was "It's the economy, stupid," and economic conditions factor prominently into presidential elections. And so what I've done here is I've gone all the way back to 1964. And I've shown in the column on the left what the misery index was doing at the time of the presidential election, not necessarily the month before, really the 6 months running up to the election, the change in the misery index. So if it's rising, households are becoming more miserable. They want to vote the bums out, so to speak. And if it's improving, they tend to reward the incumbent party. So it's not that strong economy favors Republicans and weak Democrat or anything like that. It's just incumbent versus challenger. And so when the misery index is rising, then it means regime change. And so what I've done here is taken this from 1964 all the way up to present. By success and fail, all I mean is whether the misery index successfully predicted whether or not there would be regime change. It worked pretty well with two exceptions. Carter defeating Ford in 1976, which was really more a referendum on Watergate than on the macroeconomy. And then the major three-party race, which was Clinton versus George Bush Sr., Ross Perot in the background, stealing a lot of Republican votes in that election. Also, we were just coming out of recession, so it still felt very much like the economy was in recession. So this misery index is a pretty reliable gauge. It worked with Trump over Hillary Clinton back in 2016. It also worked at the end of the COVID crisis with Biden defeating Trump in 2020. So let's take everything we talked about today, put those forecasts from the first page into the misery index. We'll turn the page, final slide of the deck, and then we'll move to Q&A. And here's the misery index heading into 2024. So maybe half of the people on this call will hang up now because they don't like the outcome. But from an apolitical standpoint, we're likely, seeing a big improvement on the inflation front over the course of the next 12 to 18 to 24 months, with some backup in the unemployment rate, but not a huge backup in the unemployment rate. That means the misery index is probably moving lower from where it is today. And that favors, whether it's Joe Biden or unnamed Democrat, at least from the misery index perspective, which the prior slide showed you works pretty well. This does favor a Democrat in winning the White House in 2024. There's lots of X factors there, so I don't want to get people too riled up. I'm just showing you what the macro indicators on their own would suggest for the 2024 presidential outcome. So that's a whirlwind tour of the U.S. economy and a relatively dismal outlook for 2023. So sorry if I've spoiled anyone's days, but I'm happy now to take some questions from the audience.
Thanks, Carl. Yeah, I guess you're right. Another way to think about the misery index is the misery index probably makes half of the people tuning in miserable and the other half not, if it's right?
Exactly.
Another way to think about the misery index.
Exactly.
So we have some great questions from the audience. So first, lots of thank yous. And it really was a fantastic overview. Thank you. So one of the questions is, at this point, do you think supply chain disruptions, and we remember the slide that showed the impact, what supply chain disruptions are contributing to inflation. Do you think supply chain disruptions or companies expanding profit margins is a bigger contributor to ongoing core inflation?
Sure. Well, that's an excellent question and an important question at that. It's a question I would have answered very differently had I been asked this 6 or 12 months ago, because 6 or 12 months ago, it was very much a supply chain story. At the moment, it has become much more, because we've seen this improvement in the supply chain. Again, some of the things I highlighted was the cost of a shipping container from Asia to Long Beach, California, rail freight shipping, trucking, costs, all these sorts of things have come down dramatically, right? One of the early ones in the pandemic was lumber costs. They, earlier this year came back to pre-pandemic levels. So the supply chain is absolutely healing. It's not healed 100%, absolutely no. But we've seen dramatic improvement on that front. We see it in the producer price index. We can see it in supplier delivery components in industrial surveys and whatnot. So the inflation at this point is more of a margin story, more of a demand story than it is a supply chain story at this moment. The other way of thinking about that, as we're heading into an economic slowdown, right? I'm not an equity analyst, but as I put my equity analyst hat on as a macroeconomist, corporate profits or corporate earnings are a function of GDP growth. And so if we have this GDP deceleration continuing into negative territory, into contraction, right? That is bad news for corporate profits and earnings. So if you think of, stocks are valued using a PE ratio or a price to earnings ratio, that denominator is in for some tough sledding going forward. So I know there's been a little bit of euphoria in the markets of late, but our equity research team here is still trying to be very pragmatic, maybe a little bit pessimistic about the outlook on that. But whether we're talking about equities or it all goes down to profit margins or margins. That's a story that's driving inflation now. But as we wring the inflation out of the system, we're basically wringing the profit margins out of the system, right? So you can kind of translate that into a market view as you think about that. So it sounds great if it says, oh, we're whipping inflation. It doesn't sound so good if it says, well, we're whipping corporate margins or corporate profit trends, but they're two sides of the same.
I'm one of the few that's old enough to remember whip inflation now, but okay, you had mentioned in your presentation that the Fed's hands are kind of tied. They can't lower interest rates in a dramatic way, because that's the whole point here, right? Fighting inflation. And they can't use quantitative easing because they are doing quantitative tightening. So in light of that, are there steps that Congress and or the administration, policy steps that Congress or the administration might take that could make things better in terms of the recession risk or the severity of the recession, or make things worse? Like tax cuts was a specific question.
Okay. So one big driver of inflation has been fiscal expansion, right? And some of that was obviously warranted as the economy was grinding to a halt in 2020. Did we get the prescription right? Not exactly. I mean, had we been too stingy, the outcome could have been far worse than the inconvenience of high inflation. We would have been in a very steep economic downturn. Financial markets were not functioning well. If we remember back to the first half of 2020, there would have been some real big problems. So fiscal stimulus on a massive scale was absolutely appropriate at the time because we didn't know how the pandemic was going to play out. But there was a time to remove it, and it was, we had a little too much fiscal stimulus, and it was removed a little bit too late. So we can also think of that going forward. If we're talking about fiscal stimulus, that is just making the inflation problem harder to eradicate, and then that means the Fed will have to push that much harder on the policy levers. So, there are supply siders out there who will say, tax cuts will, boost the economy and whatnot. We need to slow down the economy at the moment. So, could we maybe do this in a way to avoid recession? There's a way that could happen, but it doesn't look like that's a baseline scenario. But any type of fiscal stimulus, whether it's tax cuts or rebate checks or student loan relief or whatnot, is, they may be desirable for their own reasons. You may have a non-macroeconomic factor that is motivating you to say, yes, we should give student loan relief or other types of or tax cuts or whatnot. The point is, if you're doing things that are speeding up the economy, then the Fed is going to have to push that much harder on the brake pedal. So it's 1 foot on the gas and 1 foot on the brake pedal. Not a great way to drive. So that's kind of how we should think about fiscal policy. There could be some opportunities for enhancing the productivity of the economy, and then you can have growth without necessarily the inflationary aspects of it. So things like smart infrastructure spending, right? If we have more efficient ports, highways, airports, rail infrastructure, etc., that can be spending that turns out to not be inflationary in the long run. But in terms of spending the inflation, now I'll make the other side of the room half. So if half tuned out when I showed the misery index, we can talk about the Inflation Reduction Act. There's some very favorable elements to that. It's not the best name for it. I don't know if it's really an inflation reducer. Whether we're promoting onshoring of industry and stuff, that's a whole other debate. And I think those are worthwhile debates to be having. An inflation reducer, if it has a positive price tag on it, it's really not much of an inflation reducer. So a bit of a misnomer on that front.
Great. Okay, we have a question. Do you expect any increase in firms or households' default rate above historical average? Otherwise, how can or where does the predicted recession come from?
Sure. So the predicted recession comes from the Fed tightening policy to a point where the economy slows so much that it is actually moving into reverse, right? It's sliding into contraction. The cost of financing is above the growth rate in the economy, so things tend to fall apart. Income slow, unemployment rises. Now, when I say income slow, we can talk about corporate income, we can talk about household income, all of those decelerate, right? As a natural byproduct of that, you have rising default rates. And we already are starting to see, signs of this in the credit markets as spreads are starting to widen. To this point, default rates are still low, whether we're talking about households or businesses, but it's starting to tick higher. Whether we're talking about 90-day delinquencies on credit cards, on auto loans, on mortgage rates, even in the corporate sector, the spread widening and whatnot, we can start to see those defaults starting to edge higher. If my forecast is right, or even close to right, and we're talking about the unemployment rate going from 3.5-ish at the moment towards 6%, then the models of defaults point to higher defaults in that type of environment, right? That is a dislocation in the labor market that leads to higher defaults.
Yeah. So it's basically the unemployment rate drives the defaults, which that's Absolutely. Really the causation. Yeah.
Absolutely.
We have, I think, one more question, okay. And I'm going to turn it over to Jonathan. I think he's out there for that last question. Thank you again, Carl, and thanks to everyone for joining today.
Yeah, absolutely. Thanks, Bridget. This question came in, actually, Carl, from Skip, who asks, how much of the inflation trends are simply the effects of anniversarizing persistent inflation rates for a long enough period of time?
I'm not entirely sure I understand what this question is. The inflation trends are simply the effects of anniversarizing persistent inflation rates for a long enough time series. So I think this is asking about the kind of persistence of inflation and maybe kind of thinking about the kind of the baseline effects. So if oil prices were really high a year ago and now they're just high, then we actually see energy prices showing disinflation or negative price trend in the data. We can see the economists call these base effects, right? So oil was maybe 125, 130 towards the height of the run up last June, and now we're down to kind of 70 to 80 dollars per barrel territory on West Texas. So still high, but obviously almost basically half of where we were in that earlier period. So a big part of what we're seeing on the turn on inflation right now is coming from that, from energy prices, from goods prices. We've had this run up in the dollar. All of these factors are kind of like one-off shocks that then, if you're measuring something in 12-month terms, which a year-on-year rate is a 12-month rate of change, right? If it was happening 12 months ago and it's just fading away, you do start to get some moderation. The dangerous way of looking at this is then you see CPI, which was 8.5%, rolling over pretty appreciably. We see this in rents, we see this in goods prices, you see it in used car prices in particular, we see it in energy, gasoline prices and whatnot. This can create a bit of a false signal that inflation is really improving when it's really just kind of holding steady at these high or elevated levels. So it is definitely some noise we have to disentangle from the signal, and that's a reason why our firm view, my team's view, is beware of the turn in the inflation numbers we're seeing, because a lot of it is this anniversarizing or base effect taking hold, and not a real improvement. Inflation is not actually cooling; it's just the year-on-year rate kind of zeroing out. Because inflation has been high for long enough, right? If something's elevated and stays elevated for a year, eventually that inflation rate goes back to zero. And that's what we're seeing in a lot of categories. And that's why we have to, we won't be convinced that we're seeing we're seeing some improvement on inflation, absolutely. But we won't be, convinced that we're seeing real improvement or a real path back to that 2% inflation rate until we see some easing of labor conditions, right? The way to do this, right? So we can look at kind of look at relative to year ago levels and whatnot. But a major driver of the inflation trend is going to be labor costs. Labor costs are the largest input cost in almost any industry, and it certainly is the case in the service sector. And so, as I showed you that chart of average hourly earnings. We need to see average hourly earnings running around 3.5% to be consistent with 2% inflation, and we're not there. We're at 5.5% right now. So when you see the labor pressures starting to cool more appreciably, then you can say, okay, we really are returning to a low inflation regime. But until that happens, then it's a lot of this smoke and mirrors of base effects and these kind of accounting hijinks that I've highlighted to this point.
Very good, Carl. Thank you very much for your time today. Thank you all for tuning in. This will be the last series that we do this year, but we look forward to bringing back more economists to give continued unvarnished views on where the economy is headed. If we didn't get to your question, or if you have additional questions that you'd like to connect with us or Carl on, feel free to reach out. You can find our contact info at globalbusiness.org. We'll be happy to connect you with Carl as well. But thank you all very much and have a great day.
Jonathan, it's my pleasure. Happy holidays to you and a happy new year.
Absolutely. Thank you. Take care, everyone.